The Fed is clearly desperate. Knowing that interest rates are still very low, they have been trying to maintain a position that there's still a lot of room for more hikes. But it was clear from today's meeting that December might be the last hike in this cycle. How embarrassing. It's truly the weakest yet longest bull market we have seen, and it doesn't even have a leg to stand on. Unfortunately for investors, this will not end well. You came here for the truth, so let me unveil that for you. Today we're going to talk about the Federal Reserve. This is the most important institution in the entire world. What they do has more relevance even beyond their borders than any other institution out there. It is an absolute fact. Now this here gets into the details of the Fed speech that was taking place today. I'm also going to show you what they said back in October, and you can see how things have changed such a great deal in such a short period of time. And I will describe why the Federal Reserve lied to you yet again. Now, the Federal Reserve is in fact responsible for everything that happens in the markets. The Federal Reserve is engaging in quantitative tightening. For years, they had their quantitative easing policy that other central banks around the world followed. In 2018, global central banks have pulled back approximately $1 trillion in their fake fiat printed garbage. This has resulted and coincided with the turmoil that we have experienced in 2018. Is that a coincidence? I don't think so. So let's get into the speech. This information comes directly from the Federal Reserve's own website, and I'll show you the details from that. And I want to, of course, connect that in with some other information from the previous speech. But let's begin by taking a look at this. The crisis made clear that there can be no macroeconomic stability without financial stability. And of course, he's referring to the financial crisis. And that systemic stability risks, something I talk about very often take root and blossom in good times. This is exactly what I have tried to warn about on so many occasions. And it's great to see Powell saying exactly what I've talked about. Now, surely he's not going to point to a crisis. He's not going to suggest that everything is bad. In fact, all throughout the crisis, Ben Bernanke was telling everyone how everything was contained. But of course, it wasn't. It's all being used to move the markets in the way they want it to. Right now, they are trying to coerce the public into believing that there are sound fundamentals and that there is no reason to panic. However, individuals should be making preparations. So we're going to get further into this. He's talking about the asset classes and how right now he believes that there are no excesses, if you can believe it. Looking across the landscape of major asset classes, we see some classes for which valuations seem high relative to history. For example, even after standard adjustments for economic conditions, valuations on riskier forms of corporate debt and commercial properties are in the upper ends of their post-crisis distributions. Although they are short of the levels they hit in the pre-crisis credit boom, we see no major asset class where valuations appear far in excess of standard benchmarks as some did, for example, in the 90s dot-com boom or the pre-crisis credit boom. So those two instances, there were bubbles. Today, there's no bubbles, if you can believe that. Nothing to worry about. Sit down, shut up, and buy FANG stocks. That's what this Federal Reserve has done. Completely lied to the public. Again and again and again. But the only information that people see is that one line, which I'll show you in just a second, that is portrayed by the media as being a good sign for the markets. They only want to show you that, even though this speech is dozens of pages. They don't read you the whole speech. They don't give you all the good points in the speech. They just show you the little short clip so that you'll shut your mouth. The asset class that gets the most attention day to day is, of course, the stock market. Today, equity prices are broadly consistent with historical benchmarks such as forward price to earnings ratio. Not true. It is important to distinguish between market volatility and events that threaten financial stability. They're broadly consistent. Nothing to worry about. Everything is just fine. Apparently, PE ratios are normal today. Thanks, Mr. Powell. Thank you for lying to the public, making sure people aren't selling their shares. Well, what about this? Interest rates are still low by historical standards, something that I have said probably 500 times at least, and they remain just below the broad range of estimates of the level that would be neutral for the economy. That is, neither speeding up nor slowing down growth. This was the line that was reported by the mainstream media as being the reason you don't have to worry. The Federal Reserve is going to take care of you. They're going to burp you. They're going to make sure that your lullabies are playing and that you sleep soundly. Papa Fed is going to take care of you. Now that was the end of November. What happened at the meeting in the beginning of October? Look at this. Interest rates are still accommodative, but we're gradually moving to a place where they'll be neutral. Not that they'll be restraining the economy. We may go past neutral, but we're a long way from neutral at this point. We're a long way from neutral. Interesting. We're a long way from neutral. Then we have a major event that takes place. And suddenly, the wording changes entirely. Shouldn't that worry anyone? Of course not. Because as long as the Federal Reserve will remain accommodative, meaning they'll print more money and they'll continue to reduce interest rates if need be, then we have nothing to worry about. My 7 shares of Amazon are going to do just fine. People get really pissed off when I say that. The just below language is different from the long way from neutral characterization he gave at the beginning of October, which helped send the S&P 500 into a correction. He may have actually been telling the truth in October. Now, after this so-called correction, the wording changes entirely. So which one is correct? Or is it simply a matter of using forward guidance to manipulate equities? You tell me. Now I wanted to switch gears into something that's relevant. Just before we finish the video, I want to touch on 2 points. Here's the buyout that GM offered before announcing 14,000 job cuts. Before its layoff announcement, GM had offered voluntary buyouts to 17,000 employees, citing stiff competition and a tough economy. About 2,200 workers took buyouts. The company was aiming for 8,000 of them. GM announced 14,000 job cuts this week. This is an important issue, not just because of GM. I mean, it is a big company looking at tens of billions in market cap. And yet, this is a company that received a major bailout during the financial crisis. They took the bailout money, they opened up factories overseas. Nothing was done. Nothing was ever going to be put on this company. No backlash. Nothing happened. And so what do we see? Over and over again, we keep getting screwed over. The little guy is always getting screwed over. I'm all for companies moving overseas if they want to. They have the right to do that as a company, but they don't have a right to receive a bailout. That's taxpayer money being used to prop up companies. No bailouts, no subsidies. You're on your own. You want to make profits by moving overseas? You have to deal with the consequences. There's no way that I'll be convinced of giving bailouts to corporations, especially on this major scale, and making it okay. It's simply not acceptable. And this, we have Social Security, which unfortunately is already trillions upon trillions of dollars in the hole. There is no way that this could ever possibly be funded. It has gone way beyond what anybody ever comprehended. And what they're doing today is basically increasing the COLA, the cost of living adjustment, so that it's more in line with inflation, which apparently has picked up to a level that they claim is 2.8%. I believe it is much higher, but it's better than the 1.9% 10%, I believe it was, that was previously there. It's more accurate. So what they're suggesting is that this is going to increase the benefits by $39 a month, or roughly $468 a year. That's great. However, the burden only increases on the taxpayer, that they have to put more money in. So does that mean that people will have to put up more cash every single paycheck? Or is this bankrupt fund going to go further and further into bankruptcy? I don't know what direction it's going to go, but ultimately this is not going to end well, and I think that there are going to be severe cutbacks during the next crisis. We're going to see pension funds that are slashing, Social Security is going to have to be slashed. We've seen this happen before in other countries and what they have done and administered their austerity packages in one way, shape, or form. This is just going to be the next country in line. So in a matter of time, we'll see that happen. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you found this video informative, I know you'll find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can flip through the books at Amazon. There's a link in the description below. And if you want the audiobook version instead, you can get that at themoneygps.com.